Alrighty, welcome back everyone. We are going to be covering BlackRock stock, which rhymed and for some reason threw my rhythm off. I don't know why. By the way, for anyone who doesn't know what BlackRock is, it basically is an investment management company. They've also got their own ETF. They offer advisory services. You get the idea. Literally, they are an investment management company. But okay, that's enough about what they are and what they do. Let's take a look at their financials and see what's going on. But before we get to that, if you're not subbed to the channel yet, go ahead and subscribe. And if you do enjoy the kind of content I've been putting out, go ahead and give this video a thumbs up. It really does let me know that I'm going in the right direction with the content I'm making. And of course, if you ever have any thoughts on the video, or if you think there's something I could do differently to improve the quality of these videos, you can always let me know down below in the comments. Well, okay, let's get straight into it. First thing we want to look at is PE ratio. Typically, I like to see that the PE ratio is 20 or under. However, let's note that if it's a high growth company, you can justify a higher PE multiple. Now, in BlackRock's case, they don't really have extremely high growth, so this needs to be under 20. And indeed it is, right at 19.7. Okay, next we want to go ahead and take a look at their growth. So we will look at revenue, net income, and free cash flow growth. Okay, so let's see it. Revenue did grow from 2017 to 2021. We also did have growth of net income from 2017 to 2021. And the free cash flow was a little I can't really explain this. I know it's gonna sound ridiculous, but they had their earnings for the full year 2021. But for some reason, not one resource online, no sites, no Yahoo Finance. I personally have Charles Schwab as my brokerage, and they didn't even have it listed. No one had the year 2021 for free cash flow listed. And I was like, fine, I'll go find it myself. And I went to the investor relations page for BlackRock company, and I looked at their full year 2021 earnings. I scrolled through and read everything, and I could not find anything about free cash flow. I could not find anything about operating cash flow and capital expenditure, so I could try to calculate it myself. It was just literally nowhere to be seen. So if anyone can let me know why the heck free cash flow is not an available number to us yet for this company, let me know down below, because I'm sure there's just something about this company I'm missing because the business model's different, but I don't see why you wouldn't have reported free cash flow yet. I don't get it. Now, honestly, based on the trajectory they seem to be going in, 2021's free cash flow probably would have been the highest they've ever had, so it would have been an increase from 2017 to 2021, but we don't have that to go on. So free cash flow in 2017 was about 3.8 billion. And if you look at the other years ahead of it, they never touched it again. Not sure why that year was so high, but it was. Okay, so next we'll go ahead and take a look at the debt for BlackRock. Now, I typically like to take the average last 5 years of free cash flow. In this case, it was roughly 3 billion. And we multiply that by 3, and that gave us a figure of 9 billion. Now we want to see that our long-term liabilities are under that amount. Well, in this case, they're not. It's 20.5 billion. So far on the debt, I don't like the look of it. And in the case of current ratio, it's not something I am able to run on this company. So I'm gonna take a guess and say the reason there can't be a current ratio, because none of the sites had one listed, and I couldn't find current assets or current liabilities on any sites. I'm going to take a guess we can't run it because you can't really count current assets of the company and current liabilities when you're talking about other people's assets under you. Again, different business model, so I'd assume that's why, because the majority of the company is kind of just running other people's money. So you can't really count that as your current assets. All right, so the last thing we're going to look at is the DCF model that we ran. But before that, we got to come up with a revenue growth rate that we feel good about. As usual, to get an idea of where we should start, I run a compound annual growth rate on the last 5 years of revenue, and we get 7.86%. So that was the average growth rate for the last 5 years. Now, individually, growth rates were kind of all over the place from year to year for the last 5 years. You had one year that was only 2.3%, one that was 9.8%, another that was 4.2%, and just this last year was literally 16%. A lot of all over the place there that went on. I honestly attribute the really good revenue growth of the last year to the fact that the uncertainty in this market actually is a really good thing for people who do options and are good at it. So a company like this that is going to play the market and have the necessary resources and people that are skilled enough to ride that wave up and down, essentially make a lot of money on options. It's been a much easier thing to do in the last couple years than it was before. Still, I don't like it, and to try to assume that we'd be even close to 16% revenue growth over the next 5 years. In terms of a sort of starting thing here, I'm going to stick with our compound annual growth rate of 7.86% and go from there and then look at some analyst estimates. They're around 8 to 9% for the next couple years. But remember, we need to project out over the next 5 years. So I'm going to go ahead and go with a 5% revenue growth rate over the next 5 years. Some may think this is a little low, but honestly, the point of these models is to stay conservative, to give ourselves a lot of upside potential and a good margin of safety. Plus, you never know what could happen with a company like this and its business model. You could have another year that's only like 2% revenue growth. Okay, so we go ahead to the model here and grow the revenue out by a growth rate of 5% through the year 2026, and we get about 24.7 billion. We then had to come up with a free cash flow margin to apply to all these projected revenues. Again, to get free cash flow margin, you would just divide free cash flow by revenue for the last 5 years to kind of look at all those numbers and try to find an average or something a little below it to stay conservative. Now, the high was back in 2017 at almost 28% free cash flow margin, but the rest of the years were literally very close to 20, a little under, a little over. I just decided to go with 18% free cash flow margin. We apply that to all the projected revenues. To get our projected free cash flows, we need to get a terminal value based on projected free cash flow of year 2026. We do so by also applying a weighted average cost of capital. I use 7%, and you can get the WACC from finbox.com. And we also applied a perpetual growth rate of 2.5%. Once you have all those figures, you need to then apply your rate of return that you want, or the discount rate. I like using 12%. Then we add all those figures up, and we get about 71.9 billion. You then divide by shares outstanding, which is about 152 million, and we get an intrinsic value of 473.68, or roughly $473 fair value. Now, last I checked, the share price for BlackRock was like a little over $750, so obviously the model says this is very overvalued. Some may argue I use too low of a revenue growth rate. However, remember that the point of these models is to be conservative enough to give ourselves upside potential and a margin of safety. Plus, I thought I was very fair with the free cash flow margin, almost borderline not conservative. So, based on the model, I'm inclined to believe that this is definitely overvalued. It's definitely not something I'm looking at buying. And theoretically, even if we ran like close to our compound annual growth rate over the last 5 years and went with more like 8%, I'm pretty sure this would still work out to being overvalued. But again, according to the model, this is not a buy. Okay, everybody, that's pretty much going to wrap this video up. I hope you enjoyed watching, and everyone, you have a great day.